partner at Trinity Commercial Services. Today I'm going to give you a brief description of purchase order financing. Purchase order financing is used when a company or client, in this case, is either too young or too financially weak to receive terms from suppliers, or perhaps they're getting a big order, it's too large for the supplier to support, and of course the client needs funds to purchase the product in order to meet the order. In a typical purchase order financing transaction, there's 6 parties involved. 3 on the side of the client and 3 on the financing side. On the side of the client, you have, of course, the client itself. You have the vendor from whom the client is buying the product, and of course you have the client's customer who they're selling the product to. And on the financing side, you have 3 finance companies. You have the purchase order finance company here in the middle. You have the receivable lender. You do need a receivable lender to qualify for PO finance companies funding. In this case, we're assuming you have a factoring company. And then of course there's a commercial bank. In this example that we have here, we're going to assume that we're buying a product. We're going to call this PO number 1 for $100. We're selling it for $200. That would be PO number 2, for a gross profit of $100 and a gross profit margin of 50%. You need a minimum of 25% to 30% to qualify for purchase order financing. In this example also, we'll assume that the vendor needs 15 days to produce the product, and then there'll be some transit time of approximately 30 days to ship the product to the client's customer. We're also assuming that this is a direct shipment to the end customer. It doesn't have to be. You can qualify under certain circumstances for shipments that are not direct, where the goods come to the client first. So in total, we have a 45-day purchase order cycle. So when the transaction begins, the client will be receiving a purchase order, in this case, purchase order number 2, from their customer for the $200. And they in turn will issue a purchase order, PO number 1 in our example, for $100 to their vendor. Once they have all the purchase orders issued, they will submit both purchase orders to the purchase order finance company for approval. PO finance company is going to do 2 things. 3 things actually. They're first review the POs to make sure that there's enough margin in the transaction, and we're looking for a minimum of 25%. Second thing they're going to do is contact the end customer to make sure that the purchase order is legitimate and that it's firm and non-cancelable. If the purchase order can arbitrarily be canceled, it won't be considered strong enough for the PO finance company to finance. PO finance company will also contact the receivable lender, in this case the factor, and really they're looking for a few things. They're looking for the factor to tell them that they have a limit approved for the end customer, that they intend to finance the invoice once the customer receives the product, and that they will agree to pay the PO finance company directly once they do their funding. Once the factor acknowledges that and the PO is confirmed, the transaction begins. The PO finance company will not send money, and this is important, they will not send money to the vendor prior to the vendor producing a product. Instead, they will submit the funds, the $100, to a bank. They will deposit it in the bank, and they will have the bank issue a letter of credit, documentary letter of credit, to the vendor guaranteeing 100% of the $100 purchase price once the vendor produces the product and delivers it to the ship, in this case. So the vendor then begins the production. They complete in 15 days the production of the goods. They will deliver the goods directly to the port. And this is also a very important condition. At the port, the goods have to be inspected by a third party. And this is to avoid or to argue any disputes from the customer once the product is received. Once the third party inspection is completed, the vendor will then submit the documents to the bank. Those would include the bill of lading, the invoice, and of course the inspection certificate, and any other document that's critical to the transaction. Once the bank receives the document, the vendor will then draw under the letter of credit and they will get repaid. At that point, the goods are shipped. As I mentioned earlier, we're looking at a direct shipment here. So the goods are then sent directly to the end customer. The end customer will receive the goods. The client will then submit a copy of the invoice to the factor. The factor will confirm with the customer that the goods have been received and accepted. And once they've done that, they will advance their agreed upon advance rate percentage. In this case, we'll assume an 80% advance rate. So 80% of the 200 sales price is $160. The factor will send $160 directly to the PO Finance Company. The PO Finance Company will take the $160. They will recover the $100 that they already previously advanced, and they'll recover their fee for the transaction, and the difference they'll send back to the end client. And then, of course, 30, 60 days later, the customer would pay the $200 directly to the factor. The factor will recover the $160 they advanced earlier, plus their fee, and then the difference again comes back to the client. So as you can see, it's transactional in nature. It's self-liquidating as well. Money goes to a vendor. It's collected directly from a factor. Client gets paid a small amount in the middle of the transaction, and the rest at completion. So that is a typical purchase order finance transaction. At Trinity, we also do a number of other products: factoring, asset-based lending, traditional bank financing, leasing, and some cash flow options as well. If you need some additional information about PO financing or about any other products that Trinity represents, please feel free to access our website at trinitycommercialservices.com or call us at 305-358-0777. Thank you.